The yen collapse has become disorderly. Look for a final, sharp decline before it hits a floor. By Tyler Durden. Friday, April 26, 2024, 3:40 p.m. The BOJ issued the shortest statement in the history of central banks. And left, leaving traders stunned and speechless at the sheer idiocy of the world's most clownish central bank, which has decided to invite currency collapse the same abandon as Zimbabwe, if it means pushing up domestic stunks a little bit more even as hyperinflation is unleashed among Japanese society. And now that the collapse in the yen is making banana republics like Turkey blush, and is making FX managers and traders who are still long the Japanese dong lira yen to the imploding developed insolvent, everyone wants to know what happens next. Below we share two views, one from Deutsche Bank's George Saravilos, and one from SocGen's Kit Jux. We start with the DB FX strategist who frames the BOJ's willful incompetence merely as benign neglect, to wit. On the collapse. The yen has again collapsed today to fresh record lows following the Bank of Japan meeting. We think this is warranted and that this finally marks the day where the market realizes that Japan is following a policy of benign neglect for the yen. We have long argued that FX intervention is not credible and the toning down of verbal jawboning from the finance minister overnight is on balance a positive from a credibility perspective. The possibility of intervention can't be ruled out if the market turns disorderly, but it is also notable that Governor Ueda played down the importance of the yen in his press conference today as well as signaling no urgency to hike rates. We would frame the ongoing yen collapse around the following points. Yen weakness is simply not that bad for Japan. The tourism sector is booming, profit margins on the Nikkei are soaring and exporter competitiveness is increasing. True, the cost of imported items is going up. But growth is fine, the government is helping offset some of the cost via subsidies and core inflation is not accelerating. Most importantly, the Japanese are huge foreign asset owners via Japan's positive net international investment position. Yen weakness therefore leads to huge capital gains on foreign bonds and equities, most easily summarized in the observation that the Government Pension Fund, GPIF, has roughly made more profits over the last 2 years than the last 20 years combined. There simply isn't an inflation problem. Japan's core CPI is around 2% and has been decelerating in recent months. The Tokyo CPI overnight was 1.7% excluding one-off effects. To be sure, inflation may well accelerate again helped by FX weakness and high wage growth. But the starting point of inflation is entirely different to the post-COVID hiking cycles of the Fed and ECB. By extension, the inflation pain is far less and the urgency to hike far less too. Nowhere is this more obvious than the fact that Japanese consumer confidence are close to their cycle highs. Negative real rates are great. There is a huge attraction to running negative real rates for the consolidated government balance sheet. As we demonstrated last year, it creates fiscal space via a $20 trillion carry trade while also generating asset gains for Japan's wealthy voting base. This encourages the persistent domestic capital outflows we have been highlighting as a key driver of yen weakness over the last year and that have pushed Japan's broad basic balance to being one of the weakest in the world. It is not speculators that are weakening the yen but the Japanese themselves. The bottom line is that for the JPY to turn stronger the Japanese need to unwind their carry trade. But for this to make sense the Bank of Japan needs to engineer an expedited hiking cycle similar to the post-COVID experiences of other central banks. Time will tell if the BOJ is moving too slow and generating a policy mistake. A shift in BOJ inflation forecasts to well above 2% over their forecast horizon would be the clearest signal of a shift in reaction function. But this isn't happening now. The Japanese are enjoying the ride. More in the full note available to pro subs. And next, here is the somewhat more actionable view from SocGen's FX strategist, Kit Jux. The yen's decline is becoming disorderly, which points to a final, potentially sharp, decline before it finds a floor. The Bank of Japan, as was universally expected, made no changes to interest rates at today's policy-setting meeting, though they did edge inflation forecasts higher. Forecasts for the 2025-26 fiscal year look for core inflation, ex-food and energy, at 2.1% and real GDP growth of 1%. In Japan, as in most countries, yields have tended to average more than nominal GDP growth over time, and on that basis the US/Japanese yield differential is set to narrow significantly in the coming quarters. However, for now US yields are rising and Japanese ones are still anchored by very low short-term rates. Those short-term rates give short yen trades their positive carry and have kept the leveraged trading community happy for months. The chart shows the US-Japanese yield differential and US dollar to Japanese yen over the last 20 years, with the yield chart extended using the OECD's forecasts for yields. These are just forecasts but they frame the issue quite well, particularly bearing in mind how undervalued the yen is now, on any fundamental long-term valuation. If PPP for US dollar to Japanese yen is now in the mid-90s, fair value adjusted for US exceptionalism and Japanification is still around 110. As long as yield differentials are large and growing, upward pressure on US dollar to Japanese yen persists, and while eventual return to much lower levels is inevitable, the danger here is that unless Japan's policymakers are much more aggressive with intervention and monetary policy, this move higher in US dollar to Japanese yen will end in a final excessive spike higher. 27-12284. More market stories on Zero Hedge. Russia to seize $440 million from JP Morgan. How Janet Yellen will unleash another market melt-up next Monday. Fed's favorite inflation indicator prints hotter than expected as savings rate plunges. Show comments. Discrimination notice. Privacy policy. Disclosure. Disclaimer. Advertise with Zero Hedge. Copyright 2009-2024 zerohedge.com/ABC Media, Ltd. Micro trumps macro as stocks shrug off week of higher inflation, higher rates, and lower growth. By Tyler Durden. Friday, April 26, 2024, 3 p.m. It was an ugly macro week. Source, Bloomberg. And worse still, growth surprises disappointed significantly while inflation surprises surprised to the upside significantly. Source, Bloomberg. Soaring inflation expectations sent rate cut expectations to new cycle lows. Source, Bloomberg. Pushing yields higher across the board, led by the long end. Source, Bloomberg. But, stocks didn't care about any of that because a handful of mega-cap tech stocks' earnings were awesome, except Meta, and that's what matters, for now. Source, Bloomberg. Nasdaq outperformed, up 4% on the week, its best week since the start of November 2023. The Dow was the laggard on the week, but all the majors had a decent week. Not the best week for some observers. This week saw the biggest short squeeze since the first week of March. Source, Bloomberg. And the basket of Magnificent Seven stocks soared over 5% this week, its best week since the first week of November. Fed pivot, but it was noisy as Tesla surged, Meta tumbled, and then GOOGL/MSFT lifted the lid. Source, Bloomberg. Tesla pushed back above $500 billion market cap this week and Alphabet soared above $2 TN market cap for the first time ever. Source, Bloomberg. Tech and discretionary outperformed on the week with energy and materials lagging, but all sectors ended the week green. Source, Bloomberg. 5% remains the Maginot line for the 2Y yield. Source, Bloomberg. Interestingly, the dollar ended the week practically unchanged despite a lot of noise. Source, Bloomberg. Despite the 7th straight week of declines in the yen versus the dollar, as it appears the BOJ and MOF have given up. Source, Bloomberg. Gold was dumped this week, its worst week since the start of December 2023. Spot prices did find support at $2,300 though. Source, Bloomberg. After 2 down weeks, oil prices rallied this week, with WTI back above $83. Source, Bloomberg. Finally, intraday volatility has picked up dramatically in the last couple of weeks. Source, Bloomberg. As the distribution of possible rate outcomes has picked up significantly. Don't forget next week's QRA and FOMC as Yellen and Powell get back to work. 12-36047. More market stories on Zero Hedge. Russia to seize $440 million from JP Morgan. How Janet Yellen will unleash another market melt-up next Monday. U.S. bank deposits suffer biggest weekly decline since 9/11 as taxman cometh. By Tyler Durden. Friday, April 26, 2024, 4:20 p.m. It's that time of year again and U.S. bank deposits sure showed it. While money market funds' total assets fell over $100 billion on a non-seasonally adjusted NSA basis, total bank deposits crashed by a stunning $258 billion as tax day cometh. That is considerably more than the $152 billion decline last year, but less than the $336 billion plunge in 2022. Source: Bloomberg. This makes some sense, though, as the Treasury cash balance rose by around the same amount as taxpayers did their duty and paid their fair share. Source: Bloomberg. However, on a seasonally adjusted SA basis, i.e. adjusted by the PHDS for the fact that we get large deposit outflows at this time of year to pay taxes, total deposits dropped $133 billion, the biggest weekly plunge SA since 9/11. Source: Bloomberg. Excluding foreign deposits, domestic bank deposits plunged on both an SA, minus $119 billion, large banks minus $99 billion, small banks minus $21 billion, and NSA, minus $241 billion, large banks minus $188 billion, small banks minus $53 billion, basis. Source: Bloomberg. For context, that is the largest weekly drop in SA deposits since 9/11 and the largest NSA deposit drop since April 2022, tax day. Interestingly, despite the deposit dump, loan volumes increased last week with large banks adding $5.8 billion and small banks adding $2.5 billion. Source: Bloomberg. All of which pushed the unbailed out small banks back into crisis mode, redline below constraint absent the $126 billion still in the BTFP pot at the Fed, which is slowly being unwound. Source: Bloomberg. And so, with rate cuts off the table and tapering QT very much back on, we wondered just how much jockeying between Janet Yellen and Jerome Powell is going on ahead of next week's QRA and FOMC news. 13-14629. More market stories on Zero Hedge. Russia to seize $440 million from JP Morgan. How Janet Yellen will unleash